Welcome once again, professionals. Welcome to my YouTube channel. Today, we're going to look critically on this depreciation and capital allowance. Depreciation and capital allowance. Now, we found out that most at times this depreciation and capital allowance has been something that have been interwoven. But here now, we are going to differentiate it on what really they are made up of, where they can fit in. So we're going to expatiate it the more. So without wasting much time, let's just dig deep. Now, depreciation and capital allowance are both method of what? Allocating cost of tangible fixed assets over their useful life. But they differ in their what? Application. The application differs. The purpose differs. The treatment in financial and tax accounting differs. Now, both the similarity of both is that both of them have have a method of allocating the cost of tangible fixed assets over their useful life. Depreciation and capital allowance. Let's go ahead. Let's go fully to depreciation. Depreciation. Depreciation is used in financial accounting to allocate the cost of a tangible fixed asset over its useful life. It reflects the wear and tear, deterioration, or obsolescence of the assets. Now, this place is telling us that depreciation focus more on what? Financial accounting. That depreciation is seen what? In financial statements. Depreciation help in the allocation of the cost of tangible fixed asset over its useful life. It reflects the wear and tear or deterioration or obsolescence or reduction in the value of fixed assets. You get a fixed asset for 100 naira. The first year, you depreciate it by 20 naira. The third year, 20 naira. Fourth year, 20 naira. You have a 60 naira depreciation. The value is how much now? The value of the asset will become 40. It reflects the wear and tear, deterioration, or obsolescence of fixed asset. That is the purpose of depreciation. Depreciation is used in financial what? Accounting. So just know this. Now let's go to the method. Method. Various methods can be used to allocate depreciation, such as straight line method, reducing balance method, and unit of production. The choice of these can affect the amount of depreciation and what expenses reported each year. They have different method of depreciation. Straight line method, reducing balance method, whichever method you want to adopt is fine. But the main aim is for us to know that depreciation is used in financial accounting. We are focusing on depreciation now to explain it so that we know when we hear depreciation, we know where it's coming from, we know where to fix it, and we know how to explain it. That is the essence of this. The method, we have the method. Now let's move down. The accounting, the treatment. Depreciation expense is recorded what? On the income statement. Depreciation expense is recorded on the income statement. Now, what, like I earlier said, when you get an asset for 100 naira, you depreciate it by 20 naira. Now, the depreciation will appear where? In the income statement. as an expense. It will appear in the income statement as an expense. Then the remaining 80 naira will appear where? In the financial position. So these are the two areas where they appear in the financial statement. Depreciation. Accounting, accounting treatment, depreciation expense is recorded on the income statement, reducing the company reported earning. The accumulated depreciation is recorded on a balance sheet as a contra asset, reducing the net book value of the asset. You might not understand this English here, but I have explained it in a layman language that you can get. The treatment here is just that the amount in which the asset is being depreciated by will appear in the income statement. And the remaining figure, which is the carrying amount, the value of that asset will appear in the financial position. That is the accounting, that is the treatment there. When you are working with TB, extended TB, and you pass your journal, you will understand this. But we're not heading to that yet. That is just the treatment. Now let's take a look at the regulation. Regulation depreciation is governed by what? Accounting standards such as IFRS or GAAP and the company's accounting policy. International financial reporting standard or generally accepted accounting principle. These are the regulations that guide depreciation. It is from this standard that depreciation emanated from. The standard might say depreciation is like this. Depreciation is like this. We must follow this standard in apportioning our depreciation. So depreciation is regulated by this standard. International financial report, international financial reporting standard or generally accepted accounting principles. That is the regulation that govern, that guide this depreciation, that regulates this depreciation. I hope we are there. Now let's go to capital allowance. I hope we, we understand what depreciation is all about. Let's continue. Capital allowance are used in tax accounting to allow a business to write off the cost of certain fixed assets against its taxable income. They are intended to encourage investment by reducing the taxable profit. In a nutshell, what they are saying here is that capital allowance is used to reduce tax liability. For example, at the end of the year, you filed on tax promise and your tax liability is 100. The capital allowance here, for example, your capital allowance is 50. That capital allowance will reduce your tax liability to 50 because initially your tax liability is 100 that you are going to pay. But with the help of capital allowance, which is 50, will now reduce your tax liability to 50. You will now pay less tax. That is the essence, the purpose of capital allowance. Hope you are getting it. Now, let's check out the method. The method for calculating capital allowance are defined by tax legislation. Common methods include initial allowance, annual allowance, balancing adjustment, and investment allowance. Let's concentrate on this because this is peculiar to Nigerians. The initial allowance, the annual allowance, balancing adjustment, and investment allowance. Now, initial allowance occur just once in the life of that asset as long as that asset is qualified for capital allowance. It happens once in the life of the asset, and the percentage differs depend on what the tax authority has said that this this particular asset should be 20%, should be 25 initial, just depends on the percentage fixed by the tax regulators or tax authorities. Annual allowance occur every year in the life of the asset. While balancing adjustment is where you have balancing charge, balancing allowance. Now, let me just explain this. When you dispose your asset and you make a profit from that asset, you hear what like balancing charge. The profit will be charged. But when you make a loss, balancing allowance, you will be allowed. Right? Investment allowance. Currently, investment allowance is no longer evoked. The Finance Act has expunged it. So what we have majorly is initial and annual allowance and balancing adjustment where necessary. All right. Now we also have the annual investment allowance, written down allowance, and first year allowance. I'm not going to explain this. I know why. You know why? Because I don't want to confuse us with this. Let's just stick with this that we are familiar with. Right? So those are the method. Now, tax treatment of this. The tax treatment. Capital allowance are claimed on a company tax return, reducing the amount of taxable profit and consequently the amount of what tax payable. They do not appear on the financial statement prepared for financial accounting purposes. Excuse me. That is the treatment. Capital allowance is mainly for what? Tax purpose. Mainly for what? Tax purpose. They do not appear in the financial statement. It's just for the purpose of reducing the tax liability of a company. Using the capital allowance, you can reduce the tax liability of a company. That is what it's meant for. That is the treatment. Now, who is the regulation? Let's check. Capital allowance are governed by tax law and regulations, which can vary by jurisdiction. These rules are set by the tax authority and can be changed with new legislation. Yes, it can be changed, just like the Finance Act. Now, the withholding, they just amended it recently. So these are the changes that can occur. They might wake up one morning and decide that you can no longer use capital allowance to reduce your tax liability. So be it. We adjust to it. So regulation, capital allowance are governed by tax law and regulation, which can vary by jurisdiction. These rules are set by what? Tax authority and can be changed with new legislation, can be changed at any time. So now let's look at the key difference. Very key, very key. The objective, depreciation is for accounting purpose to match the cost of an asset with the revenue it generates. While capital allowance are for tax purpose to reduce tax liability. Is that clear? Depreciation, accounting purpose. Allowance, capital allowance for tax purpose. Right? Good. Let's look at the regulation. We discussed that. Depreciation follows accounting standard, whereas capital allowance follows tax law. Period. Know that and know peace. Now, impact. Depreciation affect the financial statement, income statement and balance sheet. That is the only two area it affects, income statement and balance sheet. That is where you find depreciation. Whereas capital allowance affect the tax return and tax payable. It affect the tax return and tax payable. Hope we are there. Good. Let's check out the method. Depreciation method can vary widely and are chosen by the company, whereas capital allowance method are specified by tax authority. Depreciation, the method varies and can be chosen by the company which method they want to use. But capital allowance is a method that are specified by tax authority. Hope you get that. So these are the key difference that will help you to differentiate between capital, between depreciation and capital allowance. I just hope this video helps someone to understand the difference between depreciation and capital allowance and where they can be used and how they can be used and what and the regulations, who is in charge of this, who and who is in charge of this, who regulates this and who regulates that. Thank you very much for this and God bless you as we look up to for more lessons. Thank you and do have a wonderful day.